Good morning, everybody. Welcome to the Locking Your Success Trade and Market Update for the first week in March. And all I can tell you from being up here in New Hampshire, I'm really glad that spring is coming because we've had a cold, snowy winter, and I'm ready for things to warm up a little bit and get things going. All right. Before we get going, let's quickly just go over our disclaimer and let you know that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, any trades covered in the presentation may or may not be live trades. In the event something is computer simulated, we do the best we possibly can to make sure that it is accurately represented as possible. And also, the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And if you're watching this on YouTube or some other source, come on over to our website at lockingyoursuccess.com. Check out our programs, M3 Bearish Butterfly ROCK group coaching and the trading triangle programs, as well as sign up for our mailing list and get your free report, The 7 Secrets to Becoming a Successful Trader. Okay, let's take a look at the markets. So I was expecting the Russell to roll over last week, and instead it gave us another 20 points to the upside. I'm not terribly surprised about that. As I said last week, the market is acting a little bit irrationally, and it's not taking its normal reactions off of technical levels, which means basically that things are just kind of really unpredictable right now. You know, as a matter of fact, I was saying in the group mentoring sessions last Thursday that it's a very dangerous environment to be in, to be close to expiration with market neutral trades. So you may want to take that into consideration going into expiration. And you know, the reason I say this is because the market is extremely overbought on a monthly level. And actually, when I think about it, that's an understatement. I'd rather say the market's parabolic on a monthly level. If you take a look at this chart, this is just insane. A very, very, very aggressive move, and with very few or hardly any sell-offs. So basically what that means is directional traders, they don't want to miss out. They're going to keep taking shots at getting the market higher because they don't want to miss out on the gains. And at the same time, they're really nervous, and they're jumping out of their positions and buying puts at the very first sign of weakness, which means we're going to get these really, really harsh down moves with volatility spikes. And then, you know, as soon as the buyers come in, they're going to jump back on the bandwagon and push the markets higher. And that's pretty much what you've been seeing here the last few pullbacks we've had. So, you know, that being the case, the market starts to ignore technicals. And when it starts to ignore technicals, we just don't know where it's going, and we get these really harsh moves. And again, coming into expiration is not the best thing to do there. So, you know, I don't blame them for being nervous because, I mean, look at this move. I mean, if I was long in the market, I'd be pretty nervous myself. And you know, this is just the way that it's going to be until we get some sort of a reasonable consolidation here, either a large sideways move for an extended period of time, and you know, and I mean it like a couple of months, or if we get some sort of a really significant pullback, at least down to our primary trend line down here, that's way back down, you know, around 1,000, 1,050 or so. Then you know the market's going to continue to be this way. So if we take a look at the shorter-term charts, you know, what's my best guess for the week here? Well, it's going to be a little bit dependent on what the SPX does today. We got the futures, you know, they're down quite a bit, which isn't a surprise because we had a fairly large sell-off at the end of the day on Friday. We had the market came up, and the SPX broke out, and then it proceeded to sell off. As soon as I saw that, I was a little nervous coming into today, saying, well, the futures are probably going to be down. The Russell's probably going to try and retest, you know, this 1170 area. And if the SPX breaks down, it's going to pull it down even lower. So I think the best thing to do here is just basically to say, you know, what's normal market reaction at this point? Well, what should be normal for the SPX is for us to pull, you know, maybe down into this, you know, 1845, 1840 level, and then the bounce higher, because we broke out. If the market fails this level, we break down and close under here, normal would be to come down and retest this 1810 area. If the market just sells off today and then buys back up, and then we start playing either side of this resistance level, that's just more of the same that we've been having. It's irrational movement. It's not reacting properly off of support and resistance levels, and we just don't know where the market's going. It's going to be a wait and see type of thing, and like I said, that's just going to be abnormal. If we go back to the Russell, a normal pullback for today would be in this area here. I mean, we have a lot of support here now because we had this pullback, so we have a support level here at around 1160, around 1165. We got another one with our primary uptrend line here, and of course we have this 1150 level. So I wouldn't be too concerned about the downside. We break this level though, all hell breaks loose down to 1175. So as long as we stay in this range, I'd probably be okay. We start breaking down under that, then that's an issue. And then to the upside, we're just continually overextended. So, I mean, the absolute highest this would go is 1250, which is a long run from here. I would be very, very surprised, even if the SPX breaks out, if we get much over, 1210, 1215. And that's basically what I'm thinking of the markets. We're still in a wait-and-see mode. And today is going to be kind of a sign, or it could give us a sign either way. Like I said, if we just kind of end up flat here, or the SPX breaks its new support level that it broke on, or the resistance level it broke on Friday, and comes back down, closes under that, and kind of hangs there, then that's not normal. And then we just kind of in a wait-and-see mode. All right, let's talk about our positions here. Last week, I'm just going to look at the bearish butterfly first. Last week I was saying that I was bullish with the market if the SPX set new highs. Well, it did that intraday on Monday, which is not terribly surprising. However, that kind of switched me from being, okay, I think the market's coming down to, well, maybe the market's stronger than I thought. So that being the case, this position was in no shape to deal with a large up move. So Monday morning I just shut this down, and it was a little later than this. Between 10:30 and 11:30, I gradually started shutting this down, and I closed the trade out at a loss of about $11,000 or 22%. Now, again, that's not a real surprise, right? Because if you remember back on February 3rd, when we had to roll a position back because of that down move, because of, per guidelines, I told you at the time, rolling back and staying with the guidelines in the environment we had was a really, really bad idea. And that would very likely result in a losing trade if we did that. However, we would stay in the market on paper, follow the guidelines to see what happened, and pretty much what we expected to happen happened. We got the pullback, and the market's been doing the same thing it's been doing for the last year. It pulls back and it has a really, really aggressive up move, and it blows us out to the upside. In reality, what we should have done here, and we talked about this at the time, just exited it at the small profit that we had, which was like, I think, 1,700 at the time. Or what I did live with this is I rolled it back to 1,100, and I swapped over to M3 Delta guidelines. And of course, that did fine. It's not a bonus trade, but it's a let's see, I think a trade ended up being up about 5% or something. So that's the way that it should have been handled, and that's the difference between being a good trader and someone who blindly follows rules. It was obvious. I mean, we have these guidelines that work in most market conditions, but it was obvious to anybody who's kind of watching what the market's been doing that, hey, I stay in here, I follow these guidelines, I'm going to get hammered. And that was pretty much the case here. I mean, I may have been able to hold the move, but it would have been a pain in the neck. And I'd be up here probably in my, if I had that today, I'd probably be in 1160, 1160, 1180, 1200 butterfly. And if I wasn't down to max loss, I'd be darn close to it. I'd be in a high gamma position. Sometimes it's just not worth playing. And I don't like what the market's doing coming into expiration either. So, all that being the case, all the better reason just to get out. Play this game in April where we're a lot more, where we know where the market's a little bit more likely to go. All right, so that was the March bearish butterfly. As far as the March M3 trade. Let's just quickly take a look at that. That's, well, it's doing fine. Oops, this isn't the one here. This is the website one here. It's doing fine. On, let's see, Monday, if we get back on the T-log, I sold 3 1130, 1140 put verticals to help with the delta. And then on Thursday, I bought 2 1130, 1150 put verticals and 3 1130, 1140 put verticals. So if we come to the end of the week here, this is what we looked like on Monday morning. I'll go to the end of Monday. I'll show you what we looked like there. This is what we looked like here by the end of Monday. And I'm getting close to, or I could have theoretically 10 points passed along 1180. I'm usually okay to roll this up, but I really was able to control the T+0 line pretty well all the way up to the 1190 area. I was still, my Greek numbers were fine, so I wasn't that concerned with that. If we were close at expiration, this might have got rolled, but it never got rolled. So if we come all the way to Friday, I'll show you what we look like on Friday. Towards the end of the day, we're here. Delta's pretty flat. Theta is flat. Vega is slightly negative. And this is what we look like here. Of course, if we, as a trader, and I have this discretion with the M3 trade, normally going to roll up 10 points past along, but my Greeks are fine. I'm at a resistance area, and that's an area where we're likely to get a lot of market movement one way or the other if the market acts normally. And of course, if the market shoots up, then we can make some adjustments up here later. And if the market shoots down, then we're back in our tent and we should be fine. Now, since this is just a waiting game to see what the market's going to do, and we still have we've got 18 days or something till expiration, I'm still okay out here. And as long as I can control this T+0 line, I'm fine. I just assume wait the market out and see if I can get some sort of a reaction off of it. We'll see what happens today. This may be getting some moves at some point, but this is where we sit right now. As for the ROCK trade, if you remember, we entered this as an M3, but just a slightly different configuration of an M3. This did get a couple of adjustments also. Let's see. Thursday. Actually, just one adjustment on Thursday. So if we go to Thursday morning, I'll show you what the position looked like there. Oh, sorry. Option View had bad data for 3 days, so I can't go to Thursday morning. Thursday, what I did is I sold 10, 1140, 1150 put verticals to help out with my my delta. And I apologize, we can't show it on this. So I'll just show you what we looked like on Friday. We look something like this, which is very similar to the other trade because they're both essentially M3 trades, except they're just being handled a little bit differently. Same thing. Sitting here in a waiting game, it's almost like a straddle. I completely like this position. Market shoots up, we'll convert this into a ROCK trade actually, once we're sure the support level, or not, you're never sure, but once you're relatively sure that the support level is going to hold, we can run up into a ROCK trade here and play this range up in here. And of course, if we pull back, we're just going to hold the M3 position. So that is the ROCK trade for March. And let's see, we have 2 other positions on here. We have the April Bearish Butterfly, which got no adjustments, and I'll talk about that here. So by the end of the day on Friday, this is what our position looks like here. We're down about $1,400, which is really nothing for a trade like this. And I'm sitting here nearing an add point. Now I had an add point at 1190, but usually on, especially far from expiration, these bearish butterflies, I don't make any decisions till the end of the day, and we were well under 1190 by the end of the day. So we just held this position here. I do have a delta theta ratio issue going on, or maybe I even don't. I think I've had periodically throughout the trade. However, like I said, we're waiting for this darn area of resistance on the SPX to resolve itself one way or the other and give us some sort of indication we're going to back off or not. And so I'm just kind of in a holding pattern here as well. This position is perfectly fine. I really like it. So if we pull back, it will be quite nice for us. If not, then we're going to roll this to 1170 and then add the 1190s by guidelines and then continue to chase the market up. And the last thing we have going on is the April V Condor. And this had one minor adjustment on Thursday. I bought back one of these 1140 calls because our delta was too high to the upside. So this is what the current position looks like now. Again, this is perfectly fine. If we break out hard to the upside, that will be an issue. I'm not that concerned about it, though. May even consider tweaking the guidelines a little bit because I'm just not concerned with the market going much over 1210. So, and if we do that and it swings back, then that won't bother itself. And as far as the downside goes, we're perfectly fine there as well. So that is all our trades. I didn't know if anybody had any questions for the week. Can you use IWM stock instead of a Russell? I thought I answered this one once before. All right. Well, we'll go over it again anyway. Can I use IWM stock instead of Russell or IWM call in the M3? Yeah. So if you're trading an M3, perfectly fine to do IWM stock. It's perfectly fine to do. It's going to cost you a little more money. You don't get the volatility pop with a down move that helps offset the down move, but just holding an IWM stock portfolio and then trading a butterfly off of it, which is essentially what an M3 is, then in that case we could certainly just keep the IWM and trade, like I said, trade a butterfly off of it. As far as another thing you can use too, I have some people who are using TF futures. Sometimes the futures of the IWM don't exactly match the Russell, but in general, if the Russell's going up a lot, the futures are going up, and the IWM is going up. So you can use futures as well. And yep, okay. So that's it for that. All right. If we have the downside target on the Russell. Yes, downside target on the Russell. Well, we have multiple ones, right? It would be completely normal for us to reset here at 1165 and then continue to bounce. That would be a normal reset. And again, I'm kind of watching the SPX to see how that reacts. And that's going to help be an early indication on us from a technical standpoint if this is going to hold or not. If it doesn't, our next target is going to be about 1145. And if that fails, I mean, maybe 1125, but I say it's more than likely we're going to come down and retest the bottoms. So I'm really concerned if this level here doesn't hold on 1145. And of course, I'm looking at end-of-day numbers too. So if we get we might get a capitulation down under any one of these, or an intraday move. But if SPX closes decisively under 1850, that's a concern for me that it's coming down to here, which is 1815. Again, we go about the same amount of move for the Russell as we do for the SPX. So if we're 1860 in the SPX and we're going to 1815, that is, what, 45 points? That's a 45-point move on the Russell. 45-point move on the Russell from here brings us down to actually all the way down underneath a support level. So that being the case, what we're likely to see is that we get the Russell's going to support here 1145, and the SPX is probably going to end up moving a little bit more than the Russell. The SPX may come down to here and just be a little bit weaker. But anyway, our targets are right here, 1165, 1145 are our two movements, and then, of course, all the way down to bottom out. All right. Is it too early to take advantage of increased volatility today to enter the May V condor? Let's see, April, May. Okay. Yeah, I mean, if you enter the V condor, right, you have two things going against each other. You're going to get more money for your condor, but you're going to get less money for, I mean, you're going to pay more for the straddle, right, because the V condor actually isn't that negative vega. So yeah, if you wanted to stick the condor on and kind of maybe time your V going in and see what happens, then that's perfectly fine. You're more likely to have a problem to the downside, I would say, in May than you are to the upside. So just keep that in mind, and if you want to keep some sort of extra put protection, you can. On the V condor, it's generally, I mean, it's going to matter. Okay, so the question is, where do I place the straddle on a V condor? Is it always at the money, or is it skewed one way or another? Generally, when you enter a condor with 10 delta shorts on both sides, what you're going to have is a negative delta. So generally, I'll put the V 10 points under to help offset my delta a little bit. I'll still have a negative delta, but it'll be a little bit better. If the skews are crazy, in other words, if the skews are, normally doing a 15 contract, I think I have a minus 45 delta on the condor, and I'll put the straddle in, and that'll cut it down to about minus 35. But if the market skews are really weird, and I put this condor on, and I end up being, say, minus 55 or minus 60 or even minus 70 delta, I might go 20 points under the market with the straddle to help offset the delta and make it a little bit more normal. I usually won't go any further than that, so usually 10 to 20 points under. Now, of course, if I'm exceptionally bearish, that's a different story. If the market's extremely overbought and I just don't think it's going up anymore, then I may put that at the money or maybe even slightly higher, just to help deal with the likely down move that's going to happen. All right, and I believe that is all we have for questions. So I'd like to thank you, everybody, for attending. If anybody has any other questions, please feel free to email me or just ask them next week. And have a great week, everybody. And watch your positions. The market's kind of unpredictable right now. All right, goodbye.